Hello. Hello, how are you?
Hello, Professor. This is Valeria.
Oh, Valeria, I've seen you. Yeah, sure. How are you doing today?
I'm fine. How are you feeling?
Uh, I couldn't make it. I don't want anybody getting this.
Oh, stay back. Stay back. Stay where you at. Stay where you at. Stay where you at.
Yeah, we'll see next week in the class. Just the code. I don't,
Ironically, I had mom stuff to do in the house today anyway, so
no. Yeah,
it worked.
I'm glad you were able to make it here. Valeria, right?
Yes,
Got,
sir.
got your name. All right. Um, next week we'll start having our regular class. The regular campus. But by that time, this will be gone. Um, Today we'll be looking at the financial markets and the financial system. We'll begin with the financial system. We look at this diagram here. You see all this list of terms. You have retirement payments, profits, finance, happiness, wealth, social security, cost, coin, bills, and broke. All this have to do with money. And the financial market system has to do with money as well. So the financial system, when we say financial system, we are referring to the set of institutions like banks, insurance companies, and stock exchanges that permit the exchange of money or funds. So that's what the financial system does for us. It is the backbone of the economy because it allows the exchange of money and funds between the financial markets participants, like the lenders, investors, and borrowers. All of us, so long as you are working and making income and any income, and even students, anybody that have started using credit card is participating in the financial system. Anybody, because it has to do with credit card issuance is connected to the financial system. So the financial system, like I say, they facilitate the transfer of funds or money and assets between borrowers, lenders, and investors. So the main goal of the financial system is to promote economic growth and to generate the return on investment for all the participants in the system. So if you can take a look at this, you can see this diagram basically explain what the financial system does. Lenders can borrow money, and when people have a surplus of money, they can invest it or they can keep it in the financial intermediary like a bank. Then the bank can make money from there by issuing those money to borrowers in the form of loans and credit cards. Okay. Now, when they pay back the loan with interest to the financial intermediaries like the banks, and the bank can now have the money available for the depositors or the lenders. So money goes around financial system back and forth, back and forth, back and forth. And in some cases, it is the government that is the borrower. And in others, it is us, the individuals, in the form of credit cards, car loans, house loans, and so forth. Now, let's look at money itself. Money simply means anything that people use to pay for goods and services. So money has taken a different form historically. Well, in the olden days when I was growing up, there are some places where you have people exchanging goods and services. And they pay with things like uh, salt, some pay with gold, some pay with copper coins. Now, so this thing happened even before I was born. Some of them happened hundreds of years ago when the means of exchange is commodity. Now we have different forms now. Some pay with credit cards, some pay with even Bitcoin. But in any case, irrespective of the type of form that money takes, it needs to be widely accepted by both the buyers and sellers. So if you want to buy things with money, with a currency, and the seller feel that this money that you're giving him or her will be accepted as a means of exchange by other people, they will accept it. But if they're not sure, they will say, no, we can't accept that. So money for a commodity or any paper money or coin to actually serve as money, it must be something that is accepted by all buyers and sellers. A good example is the US dollar, which leads us to the barter system. In the barter system, goods and services are exchanged for are used as money. So people, that means if I want to buy something like a sandwich, I can say, okay, I have a lighter. I want to exchange it for sandwich. And that would be, if I see somebody who has sandwich and who is looking for a lighter, then we exchange. But barter is a very troublesome system because it leads to what we call double coincidence of wants. So which means that the concept of the problem of double coincidence of wants is an economic phenomenon whereby two parties each hold an item and that other wants, so they can then exchange it directly without any monetary medium. But the problem here is that it is difficult to find. If you have let's say that you want to have a lighter, you want to exchange it for sandwich. That means you have to look for somebody who has a sandwich and who is willing to exchange the sandwich with you for lighter. So it might take you the whole day before you can find that kind of that you can execute the transaction. So this which means that in an economy without money, an exchange between two people will be a problem. So, for example, if you look at this diagram that I want to show you now, this person, he has shoes. This person want to exchange for what he had is wheat, but he doesn't want shoes. See? And gosh, this person wants shoes, but it doesn't have wheat to exchange with it. You have something else. So it became a problem with barter system. That have to be that double coincidence of wants before the exchange can take place. So if a person has something like rice and he is in need of wheat, he must find another man who has wheat, but that is in need of rice before the exchange can take place. So such things are, like I said, it can be very you may not be able to meet somebody without exchange. What to have what you need. You must see somebody that have what you need, but that person is not willing to exchange it with what you want, what you have. Another one is that problem with the barter system is that there's a lack of standards of the for deferred payments. You know, in that case, if you want to buy let's say an ounce of sugar today, there's this little you can buy it with your credit card and then pay it in the future, maybe in the in next 1 month or 2 months. The debt will be there. But with barter, it's difficult to engage in contracts that involve future payments because of the lack of a satisfactory unit. So as a result of that, future payments are stated in terms of specific goods or services. But it is usually a very cumbersome system. Another thing is the lack of a common measure of value when the barter system is involved. There's no common unit of value. So even if you find a buyer or somebody who wants to buy you, let's say that you want to exchange rice for wheat, assume that you try and you are lucky, you find somebody who has wheat and who want to exchange it with you for rice. Then another problem start to ensue. The problem now becomes what quantity of rice will be exchanged for a wheat. See, it is now so now you find somebody who wants to exchange wheat with rice for you, but the problem becomes what quantity of wheat is the person willing to exchange for rice, and one quantity of rice are you willing to exchange for wheat? So money. This is where money comes from. Money solve all these problems. With money, you don't have to worry about the quantity to exchange. You just there is a common measure of value. Every quantity of wheat has a price. Every quantity of meat has a price. Money takes care of that problem for you right there. So you can look at the barter system. You can see I'll give you wheat for milk, but what quantity? This can see a lot of wheat and only a glass of milk, a small container of milk. So I'll give you milk for wheat. So it now becomes a problem. What it will be the quantity of each to exchange. Now with money, the situation have not have been taken care of. If the quantity of milk is small, you receive a lower amount of money. Let's say $1.50. And if the quantity of milk is large, they receive higher amounts. Let's say $3. Same thing with wheat. So money takes care of that problem right there. Which leads us to the function of money. Like I said, you mentioned money solve all the problems that are created by the barter system, and it serves as the medium of exchange. That is the first function. It is the medium of exchange because money acts as an intermediary. Money acts as an intermediary between the buyer and the seller. So instead of exchanging wheat for rice, they can just tell you the quantity of wheat they have, and the price of it. So each quantity have a price which you will pay, and that's also the problem. So you don't have to start looking for somebody who have wheat or rice to exchange with you, and after finding the person, you begin to look for the quantity that will be exchanged. So next is this as a store of value. So in order for the medium of exchange to work, there must be a way of storing that medium of exchange, and it will not spoil. Let me give you an example. If you're using wheat and rice, after some time, maybe a few months or a year, 2 years, they will get bad because they are commodities. But money doesn't get bad; it can stay there for 10 years. So so money must hold its value over time. Although now, even though the money itself can be there as a store of value, but sometimes the value might become eroded by inflation. But the bottom line is that it does not spoil. So now, for countries, there used to be some countries where the money loses value so quick through hyperinflation. But it became a very big problem for them. I'm going to play a clip about hyperinflation for you so that you can see what I mean by that. But what I'm trying to say here is that money as a store of value is not is good. It's unique in a way, and in a way it is not unique. But the bottom line is that money could not be stored for a long period of time due to inflation. But I mean, if the inflation rate in the country in the affected country is high, but in the United States, you can use money as a store of value because the value of the currency, even though we have inflation now, the rate of inflation can compare it to what we might have in some countries is not it's not that bad. But I've not seen a commodity, maybe except gold. Otherwise, I haven't seen a commodity, any means of exchange. I mean, the money that is much that can serve as a better store of value than the currency itself. Like US use dollars, pound use, Britain use pounds. Other countries have their currencies. The only way money may not serve as a good store of value is when the currency, the rate of inflation is high. In that case, it will cause a very big disruption in the economy. Now, money is also easily transported as a store of value. You can put your money in your wallet and pocket and travel to any place with it. But if your means of exchange is rice, you cannot be carrying out a bag of rice with you from place to place. So I can show you a clip of why where money fails as a store of value. A good example is the hyperinflation that we have in Germany. Sometimes about almost 100 years ago. See.
What?
Can you hear the sound? Hello, can you hear the sound?
I can hear it.
Okay, good.
Are you complaining about the prices constantly going up? Then you might want to watch this video about one of the most unbelievable cases of hyperinflation in history. That is hyperinflation in Germany in the 1920s, where at some point prices doubled almost every 4 days. Hyperinflation occurs when the inflation rate increases very rapidly, resulting in prices going up very fast and the currency losing its value quickly. One of the most amazing hyperinflation cases in history happened in Germany in the 1920s. As the result of World War I, the German paper mark started to lose its value, and this process accelerated in the 1920s. In 1923, prices eventually ran out of control. The prices went up so much that people were forced to spend billions of marks for daily items and were dizzied by the amount of zeros involved. As an example, a loaf of bread which cost 250 marks in January 1923 rose to 200,000 million marks in November of 1923. Or a newspaper that was sold for 1 mark in May 1922 had a price tag of 70 million marks in November 1923. It was cheaper to use the back of a 1 million mark to write notes, as a notepad would cost billions of marks. Some had to use wheelbarrows filled with cash to get a cup of coffee. At restaurants, customers had to negotiate the price of the food in advance, as there was a good chance that the price could change before the meal was served. Most restaurants did not print menus, as by the time the food would arrive, the price had already gone up. At some point, the situation got so bad that the prices were doubling almost every 4 days. There is evidence that it was cheaper to burn marks instead of wood or coal. Some used marks instead of wallpaper to decorate their walls. Children also used bundles of marks instead of toy bricks. Workers also had to negotiate their wages almost on a daily basis. Some had to use the scale to count the weight of their money to get its value, as it was difficult to count all the bills. Workers were paid twice a day so they could spend the money quickly before it lost its value. Many collected their wages in suitcases. One person who left his suitcase unattended found that the thief had stolen the suitcase but not the money. After collecting their wages, workers would quickly rush to either buy daily goods or pass the money to their family so that they'd spend it before its value had gone down. The German government eventually managed to stabilize the situation by taking a number of initiatives, including cutting 12 zeros from the paper mark and replacing it with a new currency called Rentenmark. However, the economic pressure on the Germans eventually contributed to the rise of the Nazi Party that used Germans' dire economic situation to attract public support and eventually gain power.
So you can see from this clip what can happen when a currency lost the value. Let me play the clip again. I don't know if you see the clip. Okay, we'll continue.
I don't see the clip, but I heard it.
We had it. Okay. Let me see. Okay. Okay, replay it. You can see it now, right?
Okay, this is going to sound a little nuts, but the fastest and easiest way to make passive online income on Amazon.
Yeah.
Let me replay it.
Are you complaining about the prices constantly going up? Then you might want to watch this video about one of the most unbelievable cases of hyperinflation in history. That is hyperinflation in Germany in the 1920s, where at some point prices doubled almost every 4 days. Hyperinflation occurs when the inflation rate increases very rapidly, resulting in prices going up very fast and the currency losing its value quickly. One of the most amazing hyperinflation cases in history happened in Germany in the 1920s. As the result of World War I, the German paper mark started to lose its value, and this process accelerated in the 1920s. In 1923, prices eventually ran out of control. The prices went up so much that people were forced to spend billions of marks for daily items and were dizzied by the amount of zeros involved. As an example, a loaf of bread which cost 250 marks in January 1923 rose to 200,000 million marks in November of 1923. Or a newspaper that was sold for 1 mark in May 1922 had a price tag of 70 million marks in November 1923. It was cheaper to use the back of a 1 million mark to write notes, as a notepad would cost billions of marks. Some had to use wheelbarrows filled with cash to get a cup of coffee. At restaurants, customers had to negotiate the price of the food in advance, as there was a good chance that the price could change before the meal was served. Most restaurants did not print menus, as by the time the food would arrive, the price had already gone up. At some point, the situation got so bad that the prices were doubling almost every 4 days. There is evidence that it was cheaper to burn marks instead of wood or coal. Some used marks instead of wallpaper to decorate their walls. Children also used bundles of marks instead of toy bricks. Workers also had to negotiate their wages almost on a daily basis. Some had to use the scale to count the weight of their money to get its value, as it was difficult to count all the bills. Workers were paid twice a day so they could spend the money quickly before it lost its value. Many collected their wages in suitcases. One person who left his suitcase unattended found that the thief had stolen the suitcase but not the money. After collecting their wages, workers would quickly rush to either buy daily goods or pass the money to their family so that they'd spend it before its value had gone down. The German government eventually managed to stabilize the situation by taking a number of initiatives, including cutting 12 zeros from the paper mark and replacing it with a new currency called Rentenmark. However, the economic pressure on the Germans eventually contributed to the rise of the Nazi Party that used Germans' dire economic situation to attract public support and eventually gain power.
Okay, this is going to sound a little nuts, but the fastest and easiest way to make passive online income on Amazon is to never sell physical products. I never have, and Amazon's consistently paid me.
So you have seen the clip and what can happen to currency when it loses value, when it doesn't serve as a good store of value. Now we can go back to our lecture. The marks is the currency that the German government used in those days. Now the German government does not use marks now; they use euro now. Now another important function of money is that it serves as a unit of account. So as a unit of account, money provides a common measure of the value of goods and services that have been exchanged. So so that means when the quantity of good is higher, you pay more, and when it's less, you pay less. You know, this is not something that is easily determined with a barter system. So and next one is we can look at other functions of money, like acceptability, divisibility, portability, durability, and other things that we other functions. The first one is acceptability. So that the unit of money must be acceptable, widely accepted as a method of payment in the market for goods, labor, and financial capital. So it when you use a dollar to buy a good, the owner of the store accepts the dollar because they believe that they can use that money can be accepted any other place if they want to use it to buy goods and services for themselves. If they are not sure that it will be accepted, by their business partners or whatever they want to use it, they will not accept it from you. For example, if I bring my country's currency, the naira, here, and I want to use it to buy something in a store, in any grocery store, do not accept it because they are not sure if they use it to buy, because they know already if they use it to buy something in another store, it will not be accepted here because US does not use the naira. So that means that they have to convert it to US currency before they can use it. And that takes a lot of hassles. It's better, they are much, much better off accepting money that is used here, and they are sure that it can be accepted in other places when they want to use it to make transactions. Then next one is that it must be divisible. That means it will be capable of being divided into smaller units, like cent, $1, 1 cent, 10 cents, so that you can pay small bills with the lower units. Next one is the portability function of money. Money has to be easily carried from one place to place. So you can have your money in your wallet, and then whenever you go, you can have it in your pocket. It's easy to carry. Compare this with the barter system. They say that what you want to is use as your money is not rice or salt. It's not easy to carry salt from one place to excuse me. It won't be convenient to carry salt from one place to another, or to carry rice from one place to another. It may not even be possible to do that. So money is portable. Then durability is another function. money cannot fall apart or wear out after a few uses, then it must be difficult to counterfeit. So if people can easily fake the currency, make the fake currency, that means that currency won't have value anymore. So any question to what I have said so far? Any question? Hello? Hello, scholars, any question for me? No question?
Oh, I don't have a question.
Okay, good. Now we can now take a quick look at what is called commodity money and versus fiat money. Let's compare it. Commodity money uses objects that have a value in themselves, as well as value in their use. Things like gold, antique dollars, and even old. Some places they use salt. I already mentioned salt. But the one that is more common as commodity money are gold, mainly gold and antique dollars, like this one here. So now, as the economy become more complicated, we have the people use less of the commodity money, but the fiat money, this is the money what we call the legal tender, whose value is backed by the United States government. Each country had their own legal tender, and the government said this is what you're going to use as money. So if you compare the two, you can see that it's more convenient to use the fiat money than to use the commodity money. So, and the commodity money, fiat money is much convenient, easy to try to move from one place to another, and so on and so forth. At this point, we're ready to look at the other alternatives to money that we use these days, things like the credit cards, or the new things we have that started, we call it financial technology. Things like Cash App, Zelle, PayPal, all these things now can be a means of payment. But we may not call them money per se, but we use them as a means of payment. We call them alternatives to currency. Things like Bitcoin, and so on and so forth. In the US, almost as much as 80% of payments are cashless since 2011. So unlike the traditional money, all these alternatives do not derive their value. All these alternatives do not derive their value from the government, like fiat money. Each of these alternatives have evolved, within which it is uniformly accepted as the means of payment. Any questions? Any questions, scholars?
Questions? No questions.
Okay.
I'm sorry, same time as I'm listening to you.
Okay, good. There's one that is popular these days. They call it the virtual currency or the cryptocurrency. Places call it the Bitcoin. So Bitcoin, over the months or years, it becomes so popular. But there have been a big problem with this. One of the main trader of Bitcoin, I forgot his name. I'm sure you must be seeing this on the news. Have been arrested for fraud. When the Bitcoin, what made Bitcoin very popular is that people thought that it was the safest means of exchange, but it's not. As we can see it now, that it can be used as a means for to commit fraudulent activities. Yeah. So which means that it needs a lot of regulations. But Bitcoin have become so popular and have become so popular, so volatile, and that caused a lot of problem that many countries actually banned it, where others are thinking of issuing some kind of regulation that will govern how banks are to deal with Bitcoins. As a matter of fact, some state financial authorities have taken steps to devise regulation for Bitcoin. For example, the New York Department of Financial Services have done that. But the main responsibility for regulating Bitcoin is the US Congress. I mean, in the US here, the main agency, well, the people that have the responsibility, who can make regulations or law that will regulate
the Treasury.
Bitcoin, the Treasury. Actually, the Congress make the law, then the Treasury can now implement it. So that if the Congress doesn't make the law, that we guide the implementation of those regulations, the Treasury their hands will be tied. So now we can also another popular alternative to currency is the mobile commerce. We have if you have phone, especially the iPhone, there's one we call iPay. That people pay with their phones. So because of that, they call it mobile commerce. And it has become so popular that many stores are now accepting it. As of 2017, mobile commerce is worth up to 230 million, actually 230 billion annually, what stores collect. And in Walmart, noted in 2015 that 40% of all the visits to their internet shopping sites was from mobile devices. So that's how big and large mobile payments have become. So we have less than 2 minutes, 3 minutes now. We won't be able to cover much on that. So when we come back from a short break, we look at the forms of mobile payments. Any question before we go on break?
No questions.
Please remember to wait for 10 minutes before you log back in. Okay?
Okay.
All right, see you back here in 10 minutes.